Welcome to the Andrew Holland Podcast, where we talk about business, entrepreneurship, and everything in between. Now, here's your host, Andrew Holland.
Hello, everyone, and welcome to another episode of the Andrew Holland Podcast. I'm your host, Andrew Holland. I'm a businessman. I'm an entrepreneur. I've worked as a CPA in the corporate world, and I've worked in the investment and financial services industries. I've started and sold multiple companies with multi-million dollars in valuation and multi-million dollars in revenue. You can find more about my background and the podcast at our website, theandrewhollandpodcast.com. Also, be sure and follow me on Twitter, @HollandPodcast, where we talk about more things outside of the podcast, business related, and we often make points outside of the podcast that maybe weren't covered within that week's podcast. Lastly, subscribe to my YouTube channel, The Andrew Holland Podcast, so that you get updated notifications every week when the video version of the podcast is posted. Thank you so much for joining us each and every Wednesday for The Andrew Holland Podcast, where we talk about business, entrepreneurship, and everything in between. Today's episode is going to be a little bit different than previous episodes in that we're going to talk about something that if you're basically anywhere in the world, you have heard about. It's a relevant event, and it's particularly relevant to small business, although it's not necessarily being covered as such. I want to talk about why the collapse of Silicon Valley Bank is really a days-old story, something that's happened many times. And I'm not talking about bank runs, because that's essentially what it was, but I'm talking about what actually caused the collapse of Silicon Valley Bank. And this is a big bank, over $200 billion in assets. Why is that important to small business or to us as entrepreneurs? Well, of course, they were one of the number one banks for Silicon Valley and venture capital and tech companies. But that was pretty limited within Silicon Valley. It's not like many ma and pa shops had their deposits with them. But the reason it's important is primarily for two reasons. Why they failed, yes, it was a bank run, but really it was something that happens to many small businesses. Mismanagement of cash flows. It's really as simple as that. And one of the things that it highlights and basically brings focus to all of us as entrepreneurs is, are we managing our cash flows appropriately? And the second piece of it, diversification. Because the other reason that they failed is because they had no risk management as it relates to the diversification of their deposits. Now, we've just used a lot of big fancy words, and let's talk real simply on what happened with Silicon Valley Bank and why we as entrepreneurs should care. So Silicon Valley Bank, if you haven't heard about it, I'd be surprised because it's everywhere in the news. And of course, we're seeing concern or contagion potentially within the financial system, both in the United States and over in Europe over the last few weeks. And this is nothing new. It happened in 1929, it happened in 2008, and it happened multiple times throughout our history. And of course, there's rules and regulations that are in place to prevent this. But I don't believe that you can ever regulate greed away. And we could have a whole nother episode about why I believe this will continue to happen in the future, no matter how tight the regulations become. And you can make regulations so onerous that essentially, are you just a government-owned financial system? I don't think that's what any of us want in a capitalistic society. But we'll save that for another day. So let's just break down why we should care about Silicon Valley Bank. It teaches us a lot about, as I said, cash flow management. So for those of you who maybe aren't as familiar with what a bank is, obviously you know what a bank is, but the business model, it's actually really simple. A bank says, give me your deposits. So we deposit our money into our bank accounts. Now for us, money in our bank is an asset. It's something that has value to us. But for the bank, in this case, Silicon Valley Bank, a deposit is a liability. Why? Because they owe it to us as the depositor. We put money into our bank account, and we should be at any time be able to pull all of our money out. So how do they make money? Well, they take those deposits and they lend them out. I want to go to the bank, I want to get a car loan, and they say, yep, we can give you a car loan. Where do they make the money? Well, the difference, the interest spread, the net interest margin is a very common metric in the banking industry, is really how banks make money. It's really pretty simple. I put $100 into the bank account, they pay me 1%. They take that $100 and they lend it out to someone else at 5% for a car loan, and that 4% spread they use to cover their fixed costs, cover their employees, cover all their expenses, and then if they're managed well, they make a profit. Net interest margin. Really a simple concept. So if you haven't been exposed to how a bank works, it's as simple as that. Now, of course, it's a little bit more complicated in the sense that if I give them $100, we have capital reserve requirements. They can actually lend that out to $1,000 depending on what the reserve ratio is. But none of that is necessarily important other than to know that if everybody goes to the bank at once, all the depositors, and asks for their money back, they're not going to be able to provide it. And that's why all of our rules and regulations are in place to prevent bank runs. Came in with the 1933 and 1934 Securities Act after the 1929 stock market crash, which caused one of the first or the best well-known bank runs. Why do we care as small business owners or entrepreneurs? Well, the reality of the situation for Silicon Valley Bank is they just mismanage their cash flow. Yes, any bank that has all of their depositors come to them at once asking for all their money back is going to experience a bank run, and that's going to cause a failure. But what happened with Silicon Valley Bank is they didn't think about their cash flows. Now, what do I mean by that? So, on an average day, you have so many people that come into the bank and they ask for cash. They ask for money out. And again, I'm simplifying this because a lot of it isn't necessarily physical cash, but it's electronic transfers. It can be ACH withdrawals, it can be wires, it can be ETFs. They are wanting money out of their bank account. Well, if they have that money tied up in loans that they've lent out to other people, not a huge issue unless if they have too many depositors asking for their money. So one of the key things in the banking industry is making sure that you match what's called the duration of your assets with the duration of your liabilities. Now, what do I mean by that? Let's say that I have a checking account. That's considered an on-demand account, meaning at any point in time, I can come into the bank and I can ask my money. I can ask for my money. Now, if I have a 6-month certificate of deposit, I'm basically guaranteeing that I'll provide that money to the bank for 6 months. And because I'm willing to do that, they'll pay a little bit higher interest than they would on a checking account. And again, we're simplifying this because we just need to have the basics. Obviously, the interest rate differential between what they pay on the checking account and the certificate of deposit all depends on where interest rates are as they are set in the United States by the Federal Reserve, the yield curve. But we don't need to understand all of that to understand the basics of why Silicon Valley Bank mismanaged their cash flow. So if you have an average duration on your deposit, let's say everybody put their money into certificates of deposit that were 6 months. Obviously, that doesn't happen, but let's just say in this scenario, that's what happened. Now, if the bank makes loans that are on average 1-year loans, so let's say I go and I want to buy a car, and they say, sure, Andrew, I'll lend money to you for a car, and I'll lend you $100, and you have to pay 12 monthly payments to me, and then your car loan will be paid off. Let's say the car costs $100. Can you see how there might be an issue here if all of their depositors have an average guarantee to the bank, if you will? And again, a certificate of deposit isn't a guarantee. You can pull it out, but there's usually a penalty fee if you do it in advance of the time frame on the certificate of deposit. In our scenario, it's 6 months. If all the depositors take all their money out after 6 months, the bank is going to have a cash flow problem because the average duration on their loan portfolio, how long they've committed to their borrowers that they'll provide money to, is 1 year. So if they only have money given to them from the depositors for a guarantee of, and I'm using the word guarantee loosely here, 6 months, and they're lending it out for 1 year, you can imagine why that may create cash flow problems. Now, that's a really simplistic way to look at it, but that's exactly what happened to Silicon Valley Bank. Just a mismanagement of cash flow. Now, theirs was a little different in that they didn't necessarily lend their funds out to borrowers to make that net interest margin spread. They invested it into treasuries and commercial paper and other investments. Now, banks typically don't invest in stocks, but for ease of this conversation, or to make it relatively simple, they took our deposits, and let's say, again, in our scenario, everybody has a 6-month certificate of deposit. We're giving it to the bank for 6 months. Let's say they're paying us 1%. They took those deposits, and as opposed to lending them out to people that wanted car loans or what have you, they said, okay, let's invest these. And a lot of banks will provide or will take those deposits, and if they don't have enough borrowers, they will go and invest it into investments that pay them some type of interest rate higher than what they're paying on their deposit accounts. So what happened in Silicon Valley Bank's situation is, number one, they never anticipated that interest rates would increase as much as they did. And so what essentially happened is they had all these depositors that gave them money, and most of them were tech companies, basically companies funded by venture capital. And for the last 12 to 13 years in this country, money has been essentially free. Interest rates have been at 0%. And so the valuations and the amount of money that tech companies, new growth companies, were getting from investors, from venture capital funds, from private equity funds, was very liquid. There was a lot of money being poured into this sector of the economy. Well, it's easy to do that when it's free money. And so you had all of these tech companies that had large deposits with Silicon Valley Bank. So let's say you have the bank sitting there with lots of deposits. They don't have a lot of people lending because all of these tech companies have raised capital. So they've done what's called a seed round or a Series A or Series B, and that's a manner of financing your company with equity instead of debt. And how the bank makes money is lending money out, so would be debt to these companies. They didn't need the debt. They had raised the money and they were flush with deposits. So SVB said, okay, we need to make a spread on what we're paying to these tech companies on their deposit accounts and what we're lending the money out to, or we can't just have the money sitting there, otherwise we're not going to have a net interest margin. So they said, okay, we're going to put this money into long-term treasuries. And I don't know the exact duration of the treasuries or long-term government bonds. So relatively safe investments. The U.S. Treasury or U.S. bonds are generally considered risk-free because the government hasn't ever defaulted on their debt or meaningfully defaulted on their debt. The issue is they did this back, let's say, in January or February of 2022, when rates were still really, really low. And they put that money into bonds that were priced accordingly with interest rates at that time. So what does that mean? If I have $100, and interest rates are 0, and I put it into a bond that's at 3%, paying 3%, and my deposits, let's say on average, I'm paying 1%, I've got a 2% interest margin spread. Now, let's say the time frame on which that bond, and I know this is getting a little bit complicated, but I promise it'll all make sense, and we're keeping it as simplistic as possible, just so that you can understand the general concept of how did they get to this position of mismanaging their cash flow. It's really basic. But so back to our scenario, let's say the bond was 1 year. Well, if I'm going to hold that bond to maturity for 1 year, not a big deal. I get the full value of that bond back. It was a $100 bond plus the interest payments. Let's say it paid interest monthly. So briefly, how a bond works is I need money, or let's say the U.S. government needs money. So I go to the U.S. government and I give them $100. This is how a lot of our government debt is financed. And they say, okay, we're going to give you a 1-year bond and we're going to pay you 3%. So 3% in 1 year. Now, they make monthly payments, but let's say 3% on $100 is $3. Now, that would be paid monthly or whatever the term of the bond is. These can be variable. So I hold it for 1 year. I get my $100 par value back, and I get the interest that they paid me throughout the duration of that year of $3 because we're doing 3% on a $100 bond. Great. The bank paid depositors for that year. Let's say it stayed in the account for 12 months. They paid them 1%, paid them $1. They earned $3 on the bond. So they have $2 to cover their fixed costs and to make a profit. Great. Not a big deal, right? Well, the problem is with bonds in a rising interest rate environment, which is what we saw in 2022, the Fed raised rates very, very quickly. These bonds are issued, and I don't know the time frame. It depends if it's a 3-month or a 6-month or a 9-month or a 12-month U.S. bond or treasury. I'm kind of using the terms simultaneously or intermittently. When interest rates go up, let's say I bought a bond in January when interest rates were at 0%, and so they were paying 3% on the bond, and then interest rates go up by 1% in 3 months. Well, now, if I need to sell that bond, meaning I'm not going to hold that bond until maturity for the 12 months, that bond is going to be less valuable because other investors can go into the marketplace. And now that rates have gone up, instead of that bond only paying 3%, that bond pays, let's say, 5%. So in order for them to buy that bond from me that I'm holding that only pays 3%, there's going to be a discount to the par value, to the $100. Does that make sense? So January, I put $100 into a $100 par value bond. In 12 months, I'll get my $100 back. And over the 12 months, the length of the bond, I was getting paid, let's say it was monthly interest payments, which in total after 12 months equals $3. Let's say in March, 3 months into me owning the bond, I need to sell that bond for whatever reason. I don't have the advantage of holding it for the 12 months where I'm going to get my par value back, my $100, and have gotten the benefit of that 3% interest throughout the entire 12 months. Well, if rates have gone up between when I bought the bond and when new bonds are being issued, because the government is constantly issuing new bonds, and now someone can get a $100 par value bond that's paying 6%, why would they buy a $100 par value bond that I own that's only paying 3%, unless if they have to pay less money, the difference between basically the interest differential, unless if they get a discount. And I'm not using exact numbers. They'll say, okay, Andrew, I'll buy that bond from you in March. I could go into the market and buy a $100 bond that pays 6%, or I'll buy your $100 par value bond that's paying 3%, but I'm only going to pay $95 for it, because why would I pay $100 for your bond when I can go into the marketplace and get a $100 bond that's paying 6%? So it's kind of like if you were selling vehicles and I buy let's say a Tesla in January, and let's say I pay $100 for the Tesla. And now March comes along and a new Tesla comes out, and that Tesla is basically equivalent to what I have, but it's a lot less expensive. No one's going to pay me the same price for the Tesla that I paid because car values have gone down. It's basically the exact same thing with a bond, except bonds value, the price, goes down when interest rates go up. So let's bring that back to SVB, Silicon Valley Bank. What happened? They had all these depositors. They didn't need debt. They had raised a bunch of capital from the venture capital world and from private equity. So in order to make that net interest margin that we talked about so that they can finance their bank, pay their people, and make a profit, they took those deposits and they invested them into treasuries, bonds, relatively risk-free investments. They may have had some more risky investments, stocks and what have you, but majorly treasuries. Not a big deal, but this is where the duration of your assets and your liabilities in the banking sector is so important. Again, back to our scenario of if I have depositors who have guaranteed me money for 6 months, but I'm lending out on average for 12 months, I could be in trouble. Now, I'm not saying that a 6-month mismatch between your assets and liabilities will completely defunct a bank, but I'm presenting that as a simplistic case of recognizing where that could result in a problem if all of your depositors ask for their money back. So SVB put their deposits into longer term investments. And that wouldn't have been a problem had they not needed to cash those investments out, had they been able to hold them to maturity. Because remember, if you buy a bond, 12 months, you give them $100, you get your 3% interest payments, and you hold it to maturity, you get your $100 back plus the 3%. Well, for banks, if you invest a lot of your deposits into bonds that are longer term than your the duration on your assets, then depositors give you, again, that 12-month car loan versus 6-month CD, and then a whole bunch of people start asking for their money, number one, that presents a cash flow problem. And number two, in SVB's case, when they bought these long-term bonds, they didn't think that, we should maybe buy shorter term bonds because we're in an environment where inflation is incredibly high and the Fed's probably going to have to raise rates. They didn't think about that, something that's really pretty basic. And in the finance world, in the banking world, it's called managing your interest rate risk. Making sure that the duration of your assets and the duration of your liabilities is in sync, especially when it comes to interest rate risk. So what happened to them? They just mismanaged their cash flow. They put all of these short-term deposits into long-term bonds. Well, these long-term bonds were basically invested into when rates were at 0%. In 2022, rates went up very, very quickly. The Fed raised rates 6 or 7 times within a matter of 6 to 7 months. What happens? Well, when all of these depositors went to get their money, the bank, SVB, didn't actually have those deposits on hand because they were invested in long-term treasuries. So they were forced to sell these investments, not holding them to maturity. What had happened to the value of those investments? Well, they had gone down because rates had gone up so much. So when you looked at their balance sheet, or rather their income statement, to meet the demands of people requesting money, and people are always requesting money from their bank accounts, and this is why you need to match the duration of your assets and your liabilities. To meet the demand, they were forced to sell these securities at big losses because they couldn't hold on to them at maturity and rates had gone up. What does that mean? They just mismanaged their cash flow. Really simply stated, they mismanaged their cash flow. And then when people started realizing this, and then when depositors started being told they can't get their money back, a typical bank run ensued. A lot of the VC funds or companies, Andreessen Horowitz, the Founders Fund, A16Z, told all of their tech companies, get your money out of SVB now, because they were worried that if they didn't, they weren't going to be able to get their deposits. And so the whole thing just spiraled out of control for SVB because they didn't have all of those deposits right on hand. No bank does. They won't be able to make any money if they just took your deposits, held on to it, and did nothing with it, and then just gave it to you when you needed it. They have to make that net interest margin. Well, because they had invested in long-term investments that had gone down in value significantly and they were forced to sell them, they took huge losses on their investments. Of course, that's not going to be enough to cover the deposits. Everybody starts pulling their money and a normal bank run ensues and it goes belly up. This is the most simplistic way to describe what happened to Silicon Valley Bank. This can happen to any small business if you don't manage your cash flow. And we tend to think of these banks as complex organizations. And, if I'm a donut shop or a coffee shop or a hairstylist or, I sell goods and services, or rather goods on Amazon, or let's say I'm a manufacturer and I sell goods and give people 30 days payment terms where I can give them the product and then they'll pay me in 30 days. So you have receivables. Those can be pretty easy to understand. And we think banks are real complicated. Well, they can be complicated, but when you break it down to the business model, and SVB, this is a perfect example, they're really not that complicated. They simply didn't follow the normal principles of cash flow management. Now, every industry has a different metric or a different way or different, what I like to call key performance indicators that they need to look at to ensure they're managing cash flow appropriately. In the banking sector's scenario, it's, again, the duration of your assets versus your liabilities and interest rate risk. Really pretty basic. What was their management doing? Well, their management clearly was inept. They clearly didn't understand what they were doing. And if they did, they were either woefully ignorant or they were just in positions that they had no business being in, which I guess would be similar with woefully ignorant. Or they were, I don't want to say fraudulent, because that would indicate that they did this deliberately. I can't imagine why they would have done this deliberately. Or they were just inept and they shouldn't have been where they were. And I think if you look at the management, that very well may be the case. The causes and the things that they were focused on were more socially based, more political based, versus just running your bank and running your bank well and protecting your depositors and doing what a normal bank should do. Why is this important to us as entrepreneurs? Because we can learn from this. Always be looking at your business and saying, am I managing my cash flow appropriately? That is to say, if I have receivables, am I collecting on those receivables so that I can pay my expenses? A lot of small businesses end up failing because they mismanage their cash flow. Let me give you an example. Let's say I'm someone that produces goods. Let's say widgets. I manufacture widgets. And I sell these goods to other businesses. So it's a B2B business. Let's say I make screws. And the majority of my screws go to varying production companies that make all sorts of appliances, cars, anything that would need screws. And I give them payment terms of 30 days. That means that I ship the goods to them, they get the goods, and in 30 days they have to pay me for those goods. Well, from a financial perspective, great. When I sell the goods, I can recognize the revenue. Again, this is getting a little bit wonky from an accounting perspective, but it's pretty basic. I go to Walmart, I go to Target, I go to Whole Foods, I buy a loaf of bread, give them the cash. In that scenario, there's no receivables, but let's just make it simplistic. Let's say I go to Whole Foods or Walmart or Target and I buy a loaf of bread and they say, great, you can take the loaf of bread and make sure you pay me in 30 days. They record it as revenue because they sold it. And then they just need to make sure that I collect or I pay them in 30 days. Well, a lot of businesses forget about collecting their receivables. So they book the income, they book the sale of the loaf of bread, but they never make sure that I come around and I pay them within 30 days. And obviously things happen to people and they expect to pay, and maybe they go under or their business isn't doing as well, so they can't pay me for my screws in the scenario that we're talking about for manufacturers, or I can't pay Whole Foods, Target, or Walmart for a loaf of bread, something I bought on credit. You've maybe heard that term. And if I can't pay, if I don't get paid, well, how am I going to pay all of my vendors? So generally speaking, you want to make sure, and one of the number one ways that businesses, small businesses in particular, and quite frankly, any business can see a cash flow problem is once they've booked the sale, they've sold the loaf of bread, or I've sold screws to people, if it's on credit, they don't follow up and make sure they get the money. They don't get the cash in from that sale. And one of the things that's always driven me a little bit crazy, and this is just a result of our society being so profit driven, net income versus net loss, and so focused on the income statement, is people forget about the cash flow statement. And for every single one of us that are entrepreneurs, the cash flow statement is one of the most important statements there is to ensuring the long-term viability of the business. Don't ever forget to manage your cash flows and look at your cash flow statement. The balance sheet is really important to understand the overall health of your organization. The income statement, of course, is important if it's being accounted for properly to understand whether you're making money. But at the end of the day, what pays bills? What is actual net profit? It's cash in and out of the door. SVB simply mismanaged their cash flow statement, primarily because they didn't manage their interest rate risk and they didn't manage the duration of their assets versus their liabilities. And that's so important to remember. And really, the duration of their assets and liabilities, that may have been mismanaged, but really killed them was the interest rate risk, because their investments became they lost so much money on their investments when they were forced to sell them at huge losses to meet depositors' demands for their money. I think it's easy to look at something like SVB and say, how could they let that happen? And yes, I do look at them and say, how could they let that happen? They seem woefully inept, that they didn't see the bigger picture and they weren't managing the normal KPIs that you manage in the finance industry. But as opposed to looking at them with disdain, we should look at it and say, what would we have do differently? How do we apply that to the business or the industry that I'm in? Maybe interest rate risk isn't a key performance indicator in my manufacturing example, and maybe matching my asset duration with my liability duration isn't as key in my manufacturing of screws industry as it is for a financial institution. But the takeaway should be, am I managing my cash flow appropriately? Am I looking at the cash flow statement every month? And if you're not sure where to start with a cash flow statement or how to read a cash flow statement, and maybe you've never even heard about a cash flow statement before, email me, reach out to me. It's so crucial for small businesses, medium businesses, large businesses, all businesses to understand the importance of the cash flow statement. And so the reason I wanted to talk about SVB today is because there's so much out there going on. It failed, and why did it fail, and what have you. But if you break it down to the simplest of terms, it's a good lesson for all of us to remember. Take a step back, look at your business, and think about, how is my cash flow management doing? Am I managing my cash appropriately? Am I going to potentially run into a situation where I haven't been collecting on my receivables? Or perhaps I've got a large loan coming due and I don't have enough cash to come in, and I need to find a manner in which to make sure that balloon payment on a loan can get paid. That can easily be forgotten, and that seems surprising, but I've been there. And for those of you who have been in business for quite some time or been involved in small businesses, when you're so in the weeds of the daily operations and the HR and taking on all the responsibilities that entrepreneurs and business owners have to take on, sometimes it's easy to forget about cash flow management until it's too late. And that's certainly what happened to Silicon Valley Bank. Now, there's one other really key point that we should take away from SVB. And it's related to cash flow management, but more importantly, it's related to risk and diversification of your revenues. And I've seen this in the financing world. I'll talk in a bit about a client who was so incredibly undiversified. All their revenue stream was concentrated in one client. And that can be a very dangerous position for a business to put themselves in. What does this mean, or where did we see this with SVB, Silicon Valley Bank? Well, I don't know the exact number, so I'm going to say a number, and I don't know if it's exactly right on, but a huge majority, maybe 80%, again, I'm just making that number up, but a very large majority of their deposits came from one industry, the tech industry, from venture capital companies or companies that had been funded by venture capitals or private equity. Well, that's a really volatile industry. And to have all of your deposits come from one specific industry, that can make you very susceptible to the ailments that could cause that industry to panic. And that industry, Silicon Valley, the tech industry, is particularly volatile, especially when interest rates are rising and valuations are decreasing and their revenues are decreasing and you're seeing layoffs. People need their deposits more frequently in that particular industry to pay for expenses because people aren't spending as much money on tech or what have you. So in a perfect world, you have multiple industries where when one industry goes up, maybe another industry is going down and they balance themselves out. Or maybe multiple industries work in tandem. What you don't want is that concentration that they experienced, where if for some reason, and in their scenario, again, it was the tech industry, Silicon Valley, everybody needed their deposits quickly. And I'm not talking about the time frame when it became a bank run. I'm talking about just in advance. These companies weren't raising the capital anymore to cover their expenses. The nature of a tech company typically is you lose money for an extended period of time while you're growing your revenues, you're growing your user base. And so if you're not raising capital, and the fundraising market didn't dry up entirely, but it got a lot thinner as rates rose in 2022, and there was a fear of an economic recession, and into 2023 as we sit now, companies needed to go to their bank account and use some of that cash for normal operating expenses. Had they had a well-diversified group of depositors, sure, some demand deposits or some depositors coming to get their cash from the tech industry could be meaningful, or they would see it in their balance sheet. But if they had the oil industry, if they had some of the other industries, the healthcare industry that are doing relatively well, it wouldn't have had such a big impact. And maybe they wouldn't have had a bank run or this contagion spread. But because they were so susceptible to the ailments in one particular industry, and that's a pretty tight-knit industry controlled by really 5 to 10 meaningful individuals. As soon as they told their tech companies to take the money out, it was over for Silicon Valley Bank. What does that mean for us as entrepreneurs and small businesses, medium businesses, large businesses? Look at your revenues. Are you particularly concentrated in one sector or industry? If you are, what are the risks of doing so? Now, oftentimes when you're a small business and you're growing, and let's go back to the example of my manufacturing of screws. Maybe I get a contract with, I'm just making this up, but let's say a Ford. And I'm going to provide them all of their screws for all their vehicles for the next 3 years. What's likely going to happen is I'm going to say yes, because I'm a new business just starting out. Let's say that's the case. I need revenue, and this is fantastic. They're going to basically guarantee that they're going to buy all of their screws for their vehicles from me for the next 3 years? Great. Now, there's going to be some give and take there, and the margin you make there is probably going to be less than if you just had a one-off customer coming in. But why would you say no to that? There's nothing wrong with having that, but what you need to be mindful of is if they make up 98% of your revenue, what happens if we have another scenario like 2008 where all the car companies had to be bailed out and they're not ordering so many screws anymore? And 98% of your revenues come from this company. You, by virtue, are essentially an auto manufacturer, and you're susceptible to all of the ailments and woes that happen to that particular industry. Now, let's say that you get that contract, and a lot of times in small business, for a time period, you are heavily concentrated. Your revenue is heavily concentrated in one industry because it takes time to grow. It takes time for people to know about you and to get contracts across multiple industries. So particularly in new businesses, there may be points in time where your revenue stream is extremely concentrated, meaning coming from one particular customer or one particular industry. That's not an issue as long as you, number one, identify it. Number one, you recognize the risks that can present. And then number three, and most importantly, you don't rest on your laurels and you start trying to diversify your revenue stream over time. Perfect example. When I was working in the financial services industry, I was a commercial banker with BMO Harris Bank. And this customer actually was a little bit before my time, but my colleague, we still banked them. And for confidentiality purposes, of course, I'm not going to name them, but we still banked them. But this particular concentration of revenue issue happened a little bit before I was in the scene with them. They had been around probably for about 10 to 15 years, and they were a manufacturer of particular goods that go into, well, they go into a lot of things, but let's say automobiles, and it was automobiles. Well, there came a point in time where their revenue was so concentrated with one vendor that they were turning away, and they thought they couldn't lose them because they were guaranteed revenue. They were turning away other profitable contracts, more profitable contracts with less volume, maybe less certainty, but greater profit or less. When I say less certainty, I mean not as long of a duration, to please this one particular customer. And that resulted in two things. Number one, the customer that they were working with knew that they basically had leverage over this manufacturer and could do whatever they want. So when the next contract came up for renewal, let's say it was a 2-year contract, they knew they could pummel them on price. Because what are they going to do? Say no to them, who are providing 98% of their revenue? And so having this conversation with, in this scenario, our client, who is the manufacturer, let's just call them, I'm going to use the term manufacturer A, and they had customer B. Manufacturer A was so concentrated, their revenue was so concentrated with customer B, that they were turning away all of these other lucrative contracts that were less volume but far more profit. And eventually, my colleague had to sit down with them. And again, this concentration scenario happened prior to me coming onto the scene and working with them, and say, I know this is going to be hard for you to hear, but you need to start diversifying away from this particular customer B. Otherwise, it's going to get very painful, and they will basically own you. And that was a tough conversation, and it was a tough thing for customer A, our client, to think about. But when they saw the power that this particular customer B had over them in previous contract negotiations, they saw what they were turning away, they realized they weren't even sure they were making a profit anymore, because they had essentially narrowed down the price so much because they knew they could. What is the point in saying this? Look at your revenue stream. Is it diversified with one customer? Is it concentrated in one particular industry? If it is, you should start thinking about how can I diversify? Because if one thing happens outside of your control to this customer, maybe it's poor management like what happened in SVB. Maybe something happens and you're providing screws, in my manufacturing case, to Ford, and a huge tornado goes through and rips through the entire Ford facility, and all of a sudden their orders of screws stop because they need to rebuild their facility. And again, I don't want to say outlandish, but let's say outlandish. It was nothing you could do. Management, mismanagement, an act of God, a tornado ripping through their facility. But at the end of the day, because you were so concentrated with this one particular client, you basically pay the consequences, and it can really hurt your business. So the point in saying this, and again, I bring this up because SVB is a good lesson for two primary reasons: cash flow management and risk management, particularly as it relates to diversification, in their case of deposits, but in general, for most businesses, revenue stream. That concentration can happen by vendor, by customer, rather. If you have one customer that's basically providing 98% of your revenue. It can happen by geographical location. Depending on what industry you're in, that can be very dangerous. If you're an insurance company and you only provide insurance in Florida, and there happens to be a year where hurricanes rip through all of the territories you cover, and you have tons and tons of claims, and you have no premiums coming in from any other locations that aren't making claims, you can be in big trouble because you didn't have a diversification in the geographical location in which you were covering. You can also have risk when it comes to the industry that you're in, like we've talked about. Are you heavily concentrated in the manufacturing sector? Are you heavily concentrated in the healthcare sector? Are you heavily concentrated in the automobile sector? Are you heavily concentrated in the tech sector? Whatever it is, and there's so many different businesses and so many different industries, you need to be thinking about, what does my revenue stream look like? Am I diversified from a geographical perspective, if that's important? From an industry or sector base, if that's important? From a customer perspective, if that's important? And every different industry has different metrics and different diversification concepts or factors they need to be thinking about. If you don't know what those are for your industry, there's lots of research that you can do online. We got the internet, the world is at our fingertips to find that. If you're not sure and you're wondering, email me. Say, hey, I'm in this industry and I really like what you said about diversification. I've looked at where the majority of my revenues come from, and I'm very nervous that I'm heavily concentrated in one particular customer, or I know that that's the case. Where else could I be thinking about? How can I diversify? Or I'm not even sure what I should be thinking about or where my risks lie. Can you help me think through that? Be more than happy to do that. That's why I'm having this podcast, is to help businesses think about these things that sometimes are missed. So, key takeaways and things I want you to think about. Lessons from SVB. We see it everywhere. We see it in the news. We think, yeah, that's just another big bank that failed, or those tech guys, they're getting crazy. But take a step back, and as opposed to thinking about it that way, think about, why did they fail? Is that something that could happen to me in my industry? Am I doing the same thing they're doing, but in my industry? It's easy to point the fingers, but these types of things should be lessons or opportunities for us to learn lessons from their mistakes. And that's what it's all about, right? Failure is important because you learn from it. But if we can learn from other people's failures and apply it to our situation, again, that's the whole point of this podcast. Those who are most successful in business, they fail themselves, but then they learn from those failures, and then they try to learn from the failures of others. And when I first saw the Silicon Valley Bank scenario, again, I lived through the 2008 crisis. My first reaction was, oh boy, yep, there's that Silicon Valley mismanaging everything, banks mismanaging, getting bailed out again. And I took a step back and I thought, as opposed to pointing the finger, although you need to point fingers when they need to be pointed because we don't want this to happen again, especially when it can cause such financial disaster, particularly for the middle and poor classes. And we see that it spread to Signature Bank in New York, and we saw that it spread to Credit Suisse, and all of the appropriate regulating authorities, whether in Europe or over here, are trying to figure out how do we best deal with this. It's important to ensure that doesn't happen moving forward, although I think the greed that has caused a lot of this, whether in 2008 or SVB, you can't regulate it away. My personal opinion is until you make it a criminal offense for the C-suite, for the executive suite of these large institutions to take on this amount of risk, and so they are deterred because there are personal consequences for their actions when a bank fails, and then they have to get bailed out by the government. I don't believe anything's going to change. You can regulate these banks to death, and the only people that end up paying ultimately is the little guy, the consumer. You need to have some personal consequences for those at the top to incentivize them to manage the bank in a responsible way. We saw in 2008, I don't know if anybody ever went to prison for any of that. And I'm a huge capitalist, and I'm not a huge proponent of regulations. And the reason is not to say that we don't need any regulations. Obviously we do, but we had lots of regulations. Now people will say that we relaxed the regulations on regional banks and banks under 200 billion. You can regulate as much as you want. You're never going to regulate greed away. You need to have personal consequences for those at the top so that when they think about taking undue risk with other people's money, they recognize if I do this irresponsibly, there are going to be personal consequences. And I think that's the only way that we're going to do away with this. Getting off my soapbox and getting back to my point. So when I originally heard about SVB, that was my reaction. And then I matured, took a step back and said, what lessons can we learn from this across small business, across all business sizes, as entrepreneurs? And I felt it was important for all of us to learn from the current events of today and how they can be applied to what we're doing on a daily basis. Cash flow management, so easy to forget. Don't let that happen to you. Risk management, particularly as it relates to revenue diversification. Again, in their case, deposit diversification. In your industry, there's lots of different factors that you should consider. I'm talking just about revenue diversification. Don't let that slip away from your mindset. And again, you may be in a situation where you have to be relatively concentrated for a time period, but gradually work towards diversification in your revenue stream. That's all the time we have for today's episode of the Andrew Holland Podcast. As always, thank you so much for joining us. If you have questions about anything we talked about today, if you have questions about your particular industry, reach out, ask me those questions. Follow me on Twitter, Holland Podcast. Ask me something on Twitter. Twitter is a great place to say, hey, I'm in this industry. Other people that are in this industry, can you give me some advice? Or to ask questions or take polls. And you'll get a lot of great advice from all of us listening to the podcast and other entrepreneurs that are out there. Because maybe you've had a situation where you're concentrated and you weren't sure how to get out of it. I know that there is someone in your industry that has. And one of the beautiful things about the entrepreneurial community is we all want to help each other and grow and share. And if I can help you learn from my mistakes or others can help you learn from their mistakes, I found everybody is willing and wanting to do that because that's what makes entrepreneurship and business so interesting. At points in time, people have helped us, and we, I believe, naturally want to help other people as well. So don't hesitate to reach out to me, to ask people questions on Twitter. Again, go to our website if you want to email me, theandrewhollandpodcast.com, if you want to have a conversation outside of this podcast. And lastly, again, subscribe to our YouTube channel so that you can get updates on the video version of when the podcast is released every Wednesday. As a reminder, this is a financial and business podcast. Sometimes we talk about legal things, accounting and financial things. Obviously, today was very focused on managing cash flow and potential things you can do. Just make sure that in your scenario, you get the appropriate legal and professional help if it's required before you make any particular move. You don't want to take something you hear from this podcast or any podcast as the absolute gospel truth for your situation, apply it, and then have it go awry. Thank you so much for joining us again. I hope you have a great rest of your week, and we'll talk again next Wednesday. Thank you for listening to the Andrew Holland Podcast. Be sure to visit our website, theandrewhollandpodcast.com, for additional content on business, entrepreneurship, and everything in between. Subscribe to our YouTube channel, The Andrew Holland Podcast, to get notifications when new podcasts have been released. And lastly, follow us on Twitter, A Holland Podcast. That's A Holland Podcast, for all the conversations we're having outside the podcast. Thanks again so much for joining us this week. Have a great day, and we'll talk again next week.